Certainly. So it is a much more flexible strategy, and it needs to be, because we've got an absolute return focus, and you have to be more flexible if you're not just going to go up and down with the market. So one of the things we can do obviously is go short as well as long. Another thing is that a stock is a stock is a stock, right? So we don't have, the biggest weightings in the biggest stocks just because they're big stocks. In fact, what we like to do is have relatively even weightings across our stocks, provided they've got similar payoff targets, because that way our hit rate can come through. If we have a hit rate of 8 out of 10, which is sort of hit rate that we aim for and have achieved, then as long as we have relatively even weightings across our stocks, we can have those 1 or 2 duds out of 10, but we'll do very well in the portfolio overall. Another thing that we can do in terms of flexibility is have pre-IPO stocks. And again, as a long-only benchmark aware manager, they're not in the index, you're not going to have pre-IPO stocks, particularly when they can be taking between 9 months and 2 years to come on. But we feel as long as we've got a small enough weighting in the portfolio is very liquid anyway, and we get much bigger payoffs from those pre-IPO stocks, multi-baggers. Okay, well, there's no silver bullet to preserving capital, so we have a number of strategies. The first strategy is on the price targets. So every stock that we invest in has a payoff that we're looking for, but it also has a stop loss. And sometimes those stop losses are in case the stock price falls back, but other times those stop losses are around the investment thesis. If the thesis gets violated, we get out of the stock. The second thing that we look for in terms of preserving capital is diversification. So it's not diversification with respect to an index or tracking around an index. It's not a sector overweight or underweight versus a sector weight. Rather, it's what is the limit, the absolute limit for each stock? What is the absolute limit for each sector? Because we want a relatively even exposure across stocks and the market, so that we're not exposed to any one thing too much. And if we can look and identify an investment theme, we're not thematic investors, but if we can identify a correlated investment theme within our portfolio, we'll put limits around that as well. The third strategy that we've got is to do with our overall exposure to the market and the way that we're happy to hold cash if we can't find compelling investments. So to the extent that we have cash in the portfolio, we have a lower exposure to the market and we've reduced the systematic risk. It gets reduced further by the shorts that we put into the portfolio, and sometimes, and on occasion, we've shorted using futures, or we've put options into the portfolio as well. The last thing that we do to protect value is we can't protect it every month. We know that because we're invested in the market goes up and down. In fact, we go down 1 month out of 3 in the portfolio. But by giving ourselves 12 months for the stocks to do their things, to create this idea of having this time that rolls through that we're targeting, and we can adjust the portfolio over time as we're going towards that financial year end, if we're running into problems, that's a fourth string to our bow in terms of preserving capital.